Do you work for money or do you make your money work for you? Today, we talk about different ways to earn money via passive income, an important part in every Filipino's quest for wealth. I'm Edric Mendoza, and this is On The Money. Joining us today is registered financial planner Marvin Germo. Hi, Marvin.
Hi, good afternoon.
Afternoon. Welcome to the show.
Welcome.
It's
a pleasure to be here.
Sure. So let's talk about passive income. Let's start off by defining it. How would you define passive income? Yeah.
So first, let's look at the two types of income, right? There's what you call active, and then and then the second one is what you call passive income. When you're talking about active income, it's something where you physically have to work for your income. An example of that, if you're employed, employed. What you work for, the hours that you spend in, is proportional to the amount that you'll get.
Right. So your salary is active income.
It's active income. Keyword is you have to actively be there to actually earn from it. All right.
Good.
So we go to the second segment, which is what you call passive income. Passive income is your money working hard for you. You don't actually have to be there to make money. You can actually be in the beach while your money's working hard for you.
Right.
All right. So when we talk about investment, we talk about passive income. We can go from items that are less volatile or less, what people call less risky, to the other end where you see a lot of volatility, you see a lot of risk attached to it.
Sure.
All right. So on the lower end, that's where we see a lot of our bank accounts, our savings, time deposits, special deposits accounts. Then we move further. That's where we see real estate investing. That's where we see people using their properties as rentals. We move even further. You can see bonds. You can see money market accounts. You can see equity funds, balance funds. You move further, you can go to the stock market. Even further than that, forex derivatives.
Highest risk, okay. Forex derivatives, etc.
Yeah.
Okay. Now, so you're saying it's passive because I put my money in those instruments, and it just works for me.
Yeah.
Right. Now, what if you're a guy who, for example, you check it every day. You want to see the stock movement, and therefore you're actively involved checking it, and you're trading left and right. Is that active income, or
for me,
how do you define that? Yeah.
The definition of passive income is that even if you're not there, it's still going to work for you. So even if that person actively trades it, for example, he gets sick or goes to a beach party somewhere, it's still going to earn for him. That's the difference between
unless the stock is go down at that point.
So what I'm saying is there's a potential for it to earn even if you're not there.
Okay.
That's what passive income is. Again, even in any investment, there's a potential for it to earn, but there's also a potential for it to lose money.
Okay. Right.
And everything.
Okay, wonderful. So in that range, let's just go through it again. You're saying from the least risky to the highest risk. I mean, can you help match personalities? Let's say Juan de la Cruz is now interested in passive income.
Okay. So first of all, I'm sure everyone knows about the contingency fund. You'd put
emergency fund,
emergency fund, rainy day bucket, storehouse, whatever.
Buffer fund,
fund, whatever you call it. It's a place where you would like to park something that you needed when an emergency comes.
Liquid,
so that's where you put.
accessible.
So you put your money market funds. That's where you put your savings and current accounts. That's where you put your time deposits. That's where you have your bond funds, probably your money market accounts. So the keyword there is liquidity. When you need it, you can have it there.
Wonderful.
Okay. So for people who have
set that already,
who have their contingency funds, it's actually time for them to move further. That's where you can go to the bond market, where you can buy retail treasury bonds, you can buy corporate bonds, which outperform all the other products that we had earlier. And when we're talking about retail treasury bonds, essentially they should be risk-free because the government's supposed to back it
up. Right.
So this matches a type of investors that are sort of, they want higher returns from bank than what they get in banks, but still
savings deposit.
Savings deposits and other accounts. They want a higher yield, they want a higher return, but they don't want to subject themselves to the volatility that they see in other places.
So let's move higher. So beyond bonds.
The next foreseeable thing that I can see here for our market is we can go to real estate investing.
Okay, let's talk about that. Yeah.
When you say real estate, it can be two ways. You can buy it for capital appreciation. Meaning you'd buy the property when it's at a lower price and wait for the market to actually appreciate first, and then you sell it.
Next year it's worth more. The year after it's worth more. Okay, clear.
All right, and the next is you rent it out. But in a sense, you operate it also as a business first. Because if you're, just a heads up to everyone, you have to see first if you're really fit for that, if you want to rent it out. Because there's a lot of things that you have to consider. You have to maintain the property. You have to seek all the government, the taxes that are in that. You have to deal with the people that actually rent it out also. So that's more, until you develop the system that will manage all of that already, that's when it becomes passive for you.
Okay.
And the thing with that is, even if people are renting, the property appreciates in value.
Right.
So even if you're going for just rental income, you still get capital appreciation. The thing is, you're not just selling it.
Understood.
Okay.
So you were telling me earlier that many people actually overlook the fact that when it comes to rental income, there's actually risk.
Yeah.
You want to talk about that a little bit more?
Of course. People say that when you get properties, it's risky.
Instant.
It's there. Yeah. But the thing is, there could be a possibility also that you're expecting when your condo, for example, gets turned over, after a couple of months, no one's renting it yet. And that's a risk. That's a possibility that if you're computing your income, and especially if you're taking it off a loan, because some people, what they do for passive income is that, for example, their loan is 25,000, they rent it out for 30,000. And they have 5,000
to offset,
extra. So the risk there is, what if during your computation, you said that for the first 2 months, someone will rent it, but you're now in your third month and
nobody's renting
it. So
very good.
The risk for you is you're paying extra 25,000, which should have been paid by someone who's renting it out for you. That's one thing.
I see. So they have to factor that in. Okay.
Another thing that I can see, is if there are people who are renting it out, it would depend on how wise the people who are using your facility or your condo or your house. If they're not that, they don't clean it properly, it easily depreciates. So when they're out, the possibility of other people renting it might be lesser. Or you have to make some renovations for it to be actually competitive to the others out there.
So I guess, Marvin, on that note, the property management of the building as a whole is a factor as well.
Yes,
diba?
of course.
So not just your unit, because if your unit is well maintained, but the building, what about the rental rate itself? That's a risk, right? Because you might be expecting this amount when the time comes for you to actually be able to rent it. So is that a factor?
It is. It's pretty much a factor, because you have to look at it this way also. If you rent out a condo, it's not just you who's also thinking that there. For example, you have a 300-door building that has 300 condos. Probably chances are 10%, 20% of that are also renting it out.
Right. So what is your advice on, so someone sees bonds, you talked about that, right? Sees real estate, and then maybe even stocks, etc. How would you now recommend a person to mix and match real estate into that equation or the portfolio, if you will?
For me, real estate investing fits people who would like to diverse their portfolio into something that's less risky.
Less risky.
At the end of the day, it doesn't fluctuate daily like the stock market. That's one of the advantages of it. And I've seen Filipinos that were still conservative, that they like something that's tangible, that they can see that's actually there, that's actually growing. It would help much for Filipinos if they put their properties in real estate, if they have the cash to support it. I really don't recommend that them going heavily into debt just to purchase something, because if no one rents it out, they're strapped with the debt that has. So it's just them managing the risks and rewards. Yes, do the math, do the cash flow, check if you can actually afford it. It's not worth you being strapped to something, because real estate is not as liquid as other investments. You have to find a willing buyer, and that takes time also. And you might not be able to get it at the price that you want if you sell it quickly. Generally, passive income is great because it gives you the opportunity to let other people's businesses work for you. So what am I trying to say? If I'd invest in, for example, an Ayala bond or an Ayala stock, for that matter, I can't make up my own mall to beat them. So what am I doing here? I'm leveraging on their minds. I'm leveraging on how good they are in
growing their
what
own
they
business.
do. So when they earn, I earn from it. When I'm vacationing, when I'm doing the stuff that I want to do, I'm still earning and growing from it. So it allows you to leverage the skills and abilities of other people that are better than you on something that you're not actually good at.
Well said, Marvin. So you move towards that direction, basically.
That's
excellent. We're going to have more questions in a bit, Marvin, okay? But right now, we're going to have to take a break, so stay tuned. On the Money, we'll be right back. Welcome back to On The Money. Time now for our daily dose of Salvices with Salve Duplito.
Filipinos have a love affair with land and houses. In our society, it's the haciendero that has money and power. And there's another, more practical reason.
Land or a house is something that you can see, that you can touch. And whatever happens to the economy, you have the security of owning that piece of dirt.
A lot of today's millionaires have around 2 or 3 titles tucked away, and that's their idea of retirement planning. Filipinos working overseas also buy properties to force themselves to save. Doctors particularly like putting their money in real estate, so they won't spend all their income on shoes, bags, and travel. And then a growing number of more aggressive 30 or 40-somethings are buying condominiums at pre-selling stage, looking for money by flipping. Wondering how much you can earn? Rent historically goes up 9% to 11.8% every year, and these numbers go as far back as 1970. Prices of real estate have gone up 75.8% over the last 10 years. You could earn 25,000 monthly rental income from a small 30 square meter flat in Ortigas, Makati, or Quezon City. I know the president of an insurance company. He rents his beautiful houses in upscale subdivisions for 150,000 to 200,000 a month.
Now, even if land doesn't run away or turn into ash, you can lose money in real estate. Be mindful, the real estate sector, like the stock market, can also crash.
The World Bank warns that boom-bust cycles are intrinsic to the property market, just like in stocks and bonds. After the crisis of 1997, I saw property prices actually go down, scaring a lot of economists and analysts. I think that was the first time it happened in our economy.
Here's the lesson. Never put all of your investable funds in real estate. Keep them at 20% of your savings. This way, if you need money in a jiffy, you don't have to sell your properties at a loss.
And don't forget to budget for the cost of maintenance, association dues, and taxes. Sell to the low-cost or middle market segment and rent out to high-end. Paint is cheap, but the cost of plumbing, masonry can be a real headache if your lessees don't know how to take care of your house.
Every Filipino should have at least one real estate investment in their portfolio. Buy it when you're young so you can benefit from property appreciation. And don't forget to be ready for upswings and downswings.
Still with us is registered financial planner Marvin Germo. He will answer some of the money questions you send us via email, Twitter, and Facebook. Mel, what questions do we have for Marvin today?
Marvin, our first question comes from Grace, and she asks, in what ways does a buy and hold strategy in stocks earn money for you? Is it only when you invest in dividend-paying issues or in blue chips?
Okay, interesting question.
Yeah.
So when you say buy and hold, you're actually purchasing a stock at one price and just leave it for the long period of time. On a positive note, if you buy a really good company and you buy it really cheap, you leave it for a long period of time, you're okay.
You're happy.
You're happy. But what if you buy a certain stock at its peak? So even if you leave it for a long period of time, you'll still get an upside because you're leaving it long. But how big is it? So that's the thing that you need to consider when you're looking for...
How much are you making on it in that period of time?
Yeah, so for example, you'd buy...
So how is it performing now, basically?
Yes. So you buy something, for example, at 100, and then something happens that it goes down to 60.
Right.
And then you wait for it for a long period of time, wait for 15 years. It might come up to 130. It just gives you 30% upside for 15 years.
Yeah.
So it's not as high.
Not working for you.
So it can work if you know that the company is really undervalued to where it is right now. It can work if it's a really, really, really good company that will survive the test of time. One of the things that I look at is what Warren Buffett said, that when you look for a company, when you buy it, and even if the stock market would close, it would still be there 10 years from now. That's a good determinant.
Nice principle.
Yeah. There's a lot of companies that will be there even if there's a recession. You look for defensive stocks that if there's a recession, people will still need to take a bath. People will still need to
basic needs talaga. Okay.
on their lights. They won't say that, oh, there's a recession, I won't take a bath today. Something like that. So, right?
It must be pretty bad if that really comes to that point, right?
Exactly.
The water is too expensive, right?
Yes.
Right.
Okay. Actually, someone else has a question about tips in choosing stocks, and this comes from Melcher. Melcher asks, can you give tips in choosing which property stocks to invest in? Is it better to go for the big developers, or are smaller firms also worth looking at?
Okay, another good question.
Yeah.
In the stock market, I always tell people.
Marvin likes stocks.
Yeah,
I know.
He likes stocks. This is right up his alley.
Yes.
Okay, go for it, Marvin.
I always tell people that it's not just about picking the right company, but it's picking the right company at the right price. Because if you're buying...
How do you know it's the right price, though?
It's something you compete for. There's what you call a fair value. It's what the company is actually worth if you'd include what it is now and its future earnings. So you compute for that, and you see, for example, Ayala Land, for example, is at, for example, around 22 pesos, 23, 24 pesos. And you compute for its fair value. You compute it that it's 40 pesos. Would you buy it or not?
Yes.
Yes, because it's worth more than what it is trading for.
Yeah.
So when you see that it has a big upside, you go for it. Yeah, I'd like companies that are in growth prospects, that when they put in that where their projects are not just pumping and dumping their developments, but it goes with where the government and the economy is going. So for example, there's a lot of PPPs going on around here. There's talk,
what's
private
PPP?
Public partnerships.
Right.
So there's a lot of constructions connecting different roads, bridges going on. So what's amazing about that, if they develop around that area, chances are it would appreciate.
So
stuff
you
like
look
that.
at their vision, right?
Although you want good quality property.
Yeah.
Okay. We have another question, and this comes from May. May says, I live here in Japan. I bought 3 condos 3 years ago, 1 in Makati and 2 in the Fort. Last year, one of the Fort condos was turned over to me. My problem is I'm already having a hard time paying for the other condo that will be turned over to me March next year. Plus, I still have a 600,000 peso loan in the bank. I'm planning to sell the Fort condo, kahit palugi, to pay the balance for the second condo and my bank loan. Okay lang po ba yon?
Okay, that's
So,
Palugi, yeah.
okay.
At the end of the day, first she must look, is it in terms of a time element, does she really have to sell and pay for it right now at this very point? Because if it's not that tight at this point right now, she could actually find other means first without selling something na palugi. She can actually find stuff in her house, cars, or probably assets that they don't use, which she can use to pay for it. I'd recommend that it would be a last resort. Na there's no more chance, there's no buyers that are willing to buy it at a fair price, and she's really backed down to the wallet. She has no chance but to actually sell it at a lesser price. So for me, it's a last resort.
Okay, so you think she should offload property she already has, as in like a car or something?
Things that she can get at fair value.
Okay.
Or even a restructured loan somehow, diba?
Yeah, a restructured loan could also work. She could find something where things are consolidated. She pays it cheaper,
loan,
and then just pay that on a staggered amortization basis.
It sounds like she bit off more than she could chew, actually. Sounds like she bought these 3 condos thinking that she could rent them out, and it's just not happening.
And she's looking at the Fort condo, and Fort right now is really progressing. So you
Yeah,
don't really want to
exactly.
sell right now. I mean, like you're saying, right? Last resort if possible.
Yeah.
Fort is on the rise.
And I guess for other people that are also planning to do it, I always tell people, go with your goal first. It always has to go back with what your goal is. You don't just buy properties. You don't just invest into anything without having an entry and exit point. You have to know when you want to enter. You have to know when you need to exit. So regardless if it's a good or bad economy, you stick to your plan.
Or as an option, call Mel, right?
Call them, Should buy all 3 of them.
How much is that? How much is that?
How much are you
condo?
offering?
And,
Facebook or tweet Mel.
Who's the developer? Where exactly is it? We have another question. This comes from Anne Rodriguez. She says, I'm thinking of investing my money in mutual funds and the stock market. What are the advantages and disadvantages of mutual funds compared to stocks?
Okay, good question again. Full disclosure, I invest in stocks. I invest also in mutual funds.
Sure.
I have VULs also. They hit different types of market. I'm into stocks a lot, but I still have mutual funds for diversification. Again, they have pros and cons for each. Number one, if you're a type of person that really doesn't want to study the market anymore, you don't really want to study how it works, I guess a mutual fund will do well for you. A mutual fund that has to still fit your goals and needs and risk tolerance, because there's a lot of mutual funds that are more aggressive than others. So you find something that fits you first. But the advantages of that is you don't have to watch it.
Okay.
Marvin, you talked about the management fees also, right?
Okay,
You were saying how an added tip I heard from you is look at the mutual fund and you can actually see where they're putting their stocks and just put stocks and invest directly instead. Right?
Because
That's a good tip.
when you go to mutual funds, you're paying for professional managers. They're good at what they do.
Right.
But of course, for anything that has a premium, you have to pay for it
Management
higher
fee,
than other things. So, as compared to going to stocks directly, you just pay for the brokerage fees, you just pay for the taxes.
Sure.
But it alleviates you from those type of fees, which are, if you're putting in millions already, it's a lot there.
Right, it
It's a
adds
lot.
up.
Yeah, it adds up. And the thing, pros and cons again, in the stock market, if your stock is down, you don't sell, you don't lose anything. In mutual funds or in other types of pooled funds, you still pay a management fee if the market is up or down. So some pros and cons to each. In the stock market, if you put your stocks there, it gives you a flavor of how you want to go for it. Because in mutual funds, you're subjected to where the fund manager wants to put the money, right?
Thank you so much, Marvin. That's all we have time for today. Anyway, send us your money questions via email or through Facebook and Twitter, and we'll try to answer them in our upcoming episodes or on our next Q&A Friday.
Excellent. So passive income, active income, strike a balance, work towards passive as you grow.
Yeah, and I know what
Excellent
he's
tips.
in for.
Yeah.
Make your
We
money
know
work
that he
hard
likes
for
the
you.
stocks, right. Make your
Yeah.
money work for you. Excellent. Thank you. Great show, guys. That's our show today. I'm Edric Mendoza. Join us again tomorrow for more talk and tips so you're always right on the money.